Good evening. Welcome to the earnings review, your tidbits into company financials and operational insights. Thank you for joining us as we broadcast from our Hampton studios in Harare, Zimbabwe. I'm Ibn Mabunda, your money man. On the show, we engage top echelon executives to get you up to speed with first-hand information. We also chat with the most competent analysts on the market just to ensure you're furnished with relevant and comprehensive market analysis. Tonight, we focus on First Capital Bank, one of the listed banks on the Zimbabwe Stock Exchange. This is quite a historic bank as it has over 100 years of operation in this part of the world, Zimbabwe. This is formerly the Barclays Bank of Zimbabwe, and follow me as I take you on a journey down memory lane to get you up to speed with how the bank has evolved over the years and how the bank has come to be. The bank traces its roots to the incorporation of the Bank of Africa in 1879 in the United Kingdom. Fast forward to the year 1912, that bank was acquired by the National Bank of South Africa before it became a part of the Barclays Group. In the year 1927, this saw the political separation of Southern Rhodesia with a subsequent appointment of a committee that would oversee the operations of Barclays in Southern Rhodesia. By 1960, the bank had erected an 8-story facility in the very heart of Salisbury, which would become Zimbabwe's first safe deposit facility. 1981, the bank had been rebranded the Barclays Bank of Zimbabwe and had spread with over 50 branches across the country. Fast forward to 1991, 30% of the bank's shares were floated, which were oversubscribed by 500%. Take it over to the year 2005, the Barclays Group acquired the Absa Bank in South Africa. This, of course, cemented the bank's operations in the region. 2013, Barclays Group announced plans to incorporate the Barclays Bank of Africa. And in 2016, the bank also announced plans to exit the African market. In 2017, FMB Capital acquired a 62% stake in Barclays Zimbabwe. 2018 saw the rebranding of the bank into the First Capital Bank in association with the Barclays. Just a glance at how the group is organized. The group is a financial services provider that has a presence in 5 SADC countries, including Zimbabwe, Zambia, Botswana, Mozambique, as well as Zambia. The group provides banking and financial solutions with an employee base of over 1,700. Of note is the fact that the bank has a market capitalization of just below $1 billion United States dollars. Back to Zimbabwe, the bank plays in different market segments, providing financial solutions to individuals, retailers, institutions, as well as SMEs. The bank boasts of the widest ATM coverage with an employee base of over 700 employees. In March of 2019, the bank completed a migration from the Barclays banking system onto a completely new banking system. Some vital stats where the entity is concerned: with the current share price of 100 cents, the stock price has moved over 1,020% north vis-a-vis a 1,050% surge in the financial services index. Comparatively, the ZSE All Share has moved over 650% to date. This concludes the Halaju section of our show tonight. In just a moment, we will have a look at an earlier conversation we had with the acting Chief Executive Ciaran McSharry, as well as the Group Finance Director, who is Mr. Taitos Mukuku. Don't go anywhere. A beautiful morning it is to you, Taitos and Ciaran. Thank you for joining us on the earnings review.
It's a pleasure. We're glad to be here.
Now, to get us started, I just want to know, how are you faring with the COVID?
Oh, well, COVID's been a challenge for Zimbabwe and many other countries. But I think we've fared quite well. The lockdown initially was a challenge in terms of how we run a bank remotely. But we managed to get up and running quite successfully through a bit of innovation and using solar to run allow people to work remotely. So it was quite successful early on, and we've continued to be able to run a bank remotely, and we're now starting to get more and more people back to work because 3 months lockdown. It's time to get back to trying to run a business in this environment.
Now, Ciaran, this is coming at a time when the bank has undergone significant changes over the past 2 years. Just in a nutshell, would you want to share with us the journey and how the experience has been for you to this point?
Sure. Yeah, and it's been quite a journey over the last number of years. As you say, we've been through an awful lot of change. But I'm going to take you back a few years briefly, just from the bank was owned by Barclays, as you know. And Barclays took a decision to put the Zimbabwe business into a non-core business, which was essentially meant an asset held for sale. And in that period, they also took the decision to essentially pull out of Africa. It was the sale of the South Africa Barclays Africa Group Limited. And the reason why that's important is because it kind of put the business into a very much, as I say, a care and maintenance mode for a number of years. And then in October 17, First Capital Bank came along and acquired the Barclays interest, but retained a 10% share for a period of years. So that was the first transition. And through that, we migrated to the First Capital brand from Barclays in October 18. And as you know, we're now known as First Capital Bank in association with Barclays. And then during that period, we also had to come off all of the legacy Barclays systems. So that was a huge task. That was our core banking system, our finance system, our HR system. Every single system in the bank had to be changed and migrated to a new platform. That happened in March last year, where we migrated all of our applications. And did it go perfectly? Absolutely not. Not in a project of that size could you expect a perfect transition. But our core banking system transitioned extremely well and was very robust. We had some issues with ancillary systems, and we went through a period of stabilization, which I'm pleased to say we're now through. And we now have robust platform, robust systems, and everything seems to be performing extremely well. And during that period, we also went through, as you know, some organizational change. And that was to some extent inevitable as you go through this period. Our MD, Sam Matiketi, moved on to a new role with Old Mutual. I'm now the acting MD. And we'll be announcing a new MD in the next couple of weeks. So, that's a lot of organizational change. But I'm pleased to say that throughout all of that change, the bank continued to function and operate extremely well. Controls have been very good, and we've continued to see some growth on the balance sheet as well.
And of course, this is coming against the backdrop of several market vagaries playing out in Zimbabwe. And I would also be interested, of course, in knowing how you have navigated these volatile situations against the changes taking place within the bank.
Yeah, I'm smiling to myself because we had a group board meeting last year when our group MD narrated some of the challenges we went through as part of that migration, some of which I'd forgotten. But we went through the elections in 2017. We went through the January shutdowns. We went through a cholera outbreak. We went through a split of the RTGS and the Nostro accounts. We went through a currency change 2 weeks before we were due to go live, which did defer our go live date by a month or so, I should say. So there was a huge number of impediments and challenges to work through as part of that transition, as you say, all at a time when the economy was starting to become quite volatile. But we navigated through by concentrating really on our core business. And we had a team set up to focus very much on the project and the migration. And at the same time, we had people focused on the core business, trying to keep that business going and making sure we continue to have the right controls, etc. in place. But during that period, we also ensured that we continued to try and grow our liabilities, our assets, etc. And that was quite successful. I think, in terms of the inflationary environment also, the pricing is key. Banks are a very tightly regulated business. And we're not like other businesses where we have the ability to increase prices necessarily in line with inflation. So we have to manage across the P&L. And by that I mean we have to manage our prices, and we also have to manage our costs as well, and be very clear on that. And that's a real challenge in this environment, while ensuring you're dealing with the COVID-19 and investing the right amounts to ensure our colleague and customer safety, which is paramount, but also ensuring through a hyperinflation environment that we look after our colleagues as best we can to cushion them as much as we can against the prevailing economic conditions. So it's a tough time at the moment, and we have to be alive to those challenges. The business has to some extent be agile as well in terms of adjusting course as necessary as the policy changes come out, which we've seen an awful lot, as you know, over the last number of months, of changes in policy, changes in direction. So it does require a certain amount of agility in your business model to be able to cope with that.
I will now pass this one to you, Taitos. Can you give us the highlights of your performance over the past year right up to this point?
Okay, thank you. So in terms of the financial performance for 2019, if we look at the balance sheet, the key drivers for the balance sheet, which are your deposits and the loans, we saw growth in the RTGS loans to around 879 million. And this growth, which was 74%, was then largely deployed into RTGS loans, which also grew by 200% to around 622 million. And this was largely on the back of the stability of the core banking system after the migration had been done. From the balance sheet side, foreign currency deposits, I think they were largely, there was some growth, but it was not that significant compared to the prior year number, which was largely around closer to 57 million in terms of foreign currency deposits. From the financial impact, the first half of the year, it was largely dominated by system migration. So our transactional volumes during that period of time, they were not growing. So after the migration had happened, we then had significant growth in transactional volumes, which then boosted our income in Q2 and from Q3 to Q4. On the income statement side, in inflation-adjusted terms, the overall net loss was 163 million. But when you are looking at total equity in inflation-adjusted terms, we just had a decline of around 80 million in terms of overall equity when you are looking at inflation-adjusted terms. And the historical income statement, we had a profit of around 264 million. And the significant contribution was coming from investment property revaluation.
And then, of course, it would be essential to understand how you are performing in terms of the Forex deposits. They seem to have taken a dip from $55 million in 2018 to $50 million in 2019. What are you doing to encourage foreign currency deposits?
Okay, so in terms of encouraging more foreign currency deposits, I think it's staying closer to our customers, understanding their needs and executing their transactions efficiently. And also where we can, we also have adopted a strategy where we pick, if there are customers who are generating cash, we are picking the cash at the customer premises. So we are incurring the cost of the CIT, but at the same time, we then bring in the deposits into the bank.
Back to you, Ciaran. Your agricultural loans constitute 35% of your loan book. Given the uncertainties that the recent climatic conditions have presented, threatening the stability of the sector, how bankable are your clients in that very sector?
Look, we're confident in the agri sector that we look after. We look after a range across the sectors, but the predominance will be the large-scale agriculture operators. So we work very closely with them to ensure they are we work in partnership with them, and we always lend on the basis of very secure property. So we're very confident in them. We've worked with them for a number of years, and as I think you know, our non-performing loan ratio is really quite small. So we are very confident. We don't have any issues with those.
And on a positive one, you have an NPL ratio of 1%. How have you been able to keep your non-performing loans in check over the past years?
Yeah, I think there's a couple of things. You alluded to earlier, I think the fact that, Barclays was quite conservative. And I know when First Capital came in, there was some discussion about whether First Capital had become more risky, etc. I think we have taken a bit more risk, but we also manage very closely with our clients. We have a very robust credit process, and we ensure that we are well covered when we are lending to clients. But we also work closely with clients throughout the cycle. So we build partnerships. We make sure we continue to maintain those partnerships in a robust fashion. And where we've had clients and customers that have gone into default, we work with them to resolve the issues and try and bring that business back. And we've had a number of occasions where customers have gone into problems, but we've managed to rescue the situation and help them to come back to be a robust business and protect the loan.
Fair enough. And I'll throw this one to you, Taitos. Can you shed light on the bank's loyalty lending initiative?
Okay, so this is a product which we launched to recognize our customers in terms of their loyalty from a deposit stability point of view. So from that perspective, we look at the deposit profile, the incoming deposits for a period of 6 months, and then we look at the lowest average deposit that would have come through for the particular month. And then based on that, we then offer the customer to lend to them 80% of that average monthly deposit. I think is to show to our clients that we are recognizing them in terms of the business that they are doing with us, and also to incentivize the customers to continue depositing more with us.
And I'll throw this one again to you, Taitos. You have treasury bills worth 205 million Zimbabwean dollars. What is the maturity on these TBs given the unprecedented levels of inflation?
Okay, so the balance of 205 is largely savings bonds, the significant balance. It's investment in savings bonds. And with the savings bonds product, you are logged in for 30 days. And then after the 30 days, you will be able to sell back the savings bonds to the Reserve Bank. The reason why we have this portfolio is for liquidity management purposes. So, yes, inflation is ravaging. On the other side, we can't take it out and deploy it into the high-yielding loans because it's for liquidity management purposes. We need it to enable our customers to transact.
Ciaran, let's talk about the Tier 1 capitalization minimum requirement of 30 million United States dollars. How are you mobilizing for this very requirement?
Yeah, well, we were mobilizing before COVID-19 towards this. We have a number of properties and we have a number of plans in place to get there. I think you will see across the banking sector a challenge of hitting that number, particularly with the events of the last 3 months, number one. Number two is, and I've had this conversation with the Reserve Bank, I think setting a Tier 1 capital requirement in US dollars is a challenge, because with the volatility of the exchange rate, you're creating a potential problem for every bank that may think they're on track to hit it. And if you look at the events of the last couple of weeks and the movement in the exchange rates, albeit the parallel exchange rates, that presents banks with a real challenge. They can be on target to hit it in November, say, and by December, if the rate moves, they may not hit it. So I'm expecting that to be discussed over the next couple of months. I expect that requirement may well get extended. But we are mobilizing to try and hit that target through building our dollar balance sheet, through our dollar-denominated assets, etc. So we were working on that and aim to hit that by the end of the year.
I realize. And now to talk about the pandemic, what has been the impact on your transaction volumes during this very COVID period, starting from the national lockdowns?
So I think you'll find that in April, just after the first lockdown, where pretty much everything shut down, and we had branches, a number of core branches open only a couple of days a week, you will find that the volume declined in April. However, subsequent to April, we're seeing the volume start to pick back up as we open branches further, but also as customers migrated more and more onto our digital platforms. I think one of the impacts of COVID-19 will be you will see a lot more transaction flow going through the digital channels. And you may well see in the future a smaller footfall into the branches as people transact more and more digitally. If you look at where the Europe and the Americas are, branch network is becoming less and less important. And it's more about the digital channels. And I would see that that's going to be one of the impacts that will come out of COVID-19.
And how robust is your digital arsenal or artillery in that regard? I'm aware that you recently engaged on a digital transformation drive.
Yeah, and we have experienced a very positive time through COVID-19. We have not had any major issues with our digital platforms. Customers are transacting and we're seeing registrations increase. Now, clearly, as I say, that's got to be a focus of investment as we go forward and part of our core strategy as we move forward. We're already looking at certain exciting products that we will be launching in the next couple of months, which, more will follow. But we have got, a pipeline of things that we are trying to do and develop. And that will be part of our core strategy as we move forward.
And talking about strategy, Barclays seemed to be pretty much on a conservative lending tip. With the transformation at this point, is that still going to remain the case? What's the new strategy, so to say, if there is a shift at all?
So I think Barclays, that I referred to earlier, was absolutely a conservative lending strategy because the bank was in a care and maintenance. So there hasn't been a major shift in terms of risk profile or risk. What we are seeing is, as I said earlier, we're working more in partnership with businesses, looking to build a longer term relationship. We have a very robust credit process. So we will look at more sectors and more lending, and you've seen that growth in the balance sheet. But it will always be with a robust credit process underpinning that, because that's critical. Because when we're lending money, we're lending either money we've got on the line of credit, or we're lending money that belongs to somebody else. So we have to make sure as a bank that we protect our lending and we protect the liquidity and the balances of the bank.
Quite clear. Now, with the core branding process set to be complete this October, what is the update where that is concerned? Are you going to stick to that October given the pandemic? And also, what is your anticipated effect on your business?
Sure. We are absolutely going to stick to it. And that is certainly the plan, that we will stick to that and we will become First Capital Bank. I think the reality in the market is most people thinking of us now as First Capital Bank. I don't think the Barclays name is a big issue for people. So I'm not anticipating a big impact of the co-branding change. We will just become First Capital Bank Zimbabwe. And remember, that's part of a very Africa-focused group that operates, across, 5 countries, which is Malawi, Botswana, Zambia, Mozambique, and Zimbabwe. So, it is really quite focused on the region. And that is, I think, for us, a much better place to be compared to where we were within the non-core business of Barclays.
I realize. And how strategic is the new setup in terms of presence in the region, in terms of mobilizing resources and perhaps funding for the bank?
Well, funding for the bank isn't an issue. I think we're a well-funded bank. We don't have issues from that perspective. But what we are seeing is a greater level of leverage across the countries in terms of shared services, trying to centralize operations where we can, and make us a more efficient and effective organization. But equally, as we build forward, we look at where we have clients common across the region and how we can work together, whether it's in Botswana to Zambia, Zambia to Zimbabwe, etc. Very much leveraging our client base across those regions and helping the client to transact in a much more efficient and effective way.
And as we conclude, what is your outlook?
In this environment, the outlook is very, very difficult. With inflation where it is, with the policy inconsistencies, etc., it's very hard to have, a long-term outlook. But we're very optimistic. We have to manage through this economic crisis that we're in at the moment. And we have to build on our core strengths, which is our partnership with clients, but also then build, as I said earlier, that digital platform to enable our customers to transact more efficiently and effectively. And perhaps as COVID-19 develops in the lockdown, that digital platform, as I said earlier, will become much more relevant and essential, I think, for banking in Zimbabwe.
Optimism is pretty required. I mean, no matter the economy of the jungle, lions don't eat grass. And
No.
Any final words from you, Taitos?
Yeah, so I think like what Ciaran said, it's for us to continue looking forward and steer the bank through the current environment which we are in, and continue to remain profitable.
Fair enough. Well, that was quite comprehensive. Thank you, Taitos. Thank you, Ciaran, for making the time to have a chat with the team here at Equity Access.
A pleasure. Thank you for your time.
Fantastic.
For your time.
I wish you a good luck in the ensuing financial season. Welcome back, viewers. That was, of course, Ciaran as well as Taitos, the acting chief executive as well as the finance director, respectively, for First Capital Bank. And now joining us for an analysis of the performance of the entity is our very own chief analyst, Respect Gwenzi. Respect, good evening and welcome to the Earnings Review.
Good evening to you too, and thank you for having me here.
Beautiful. Two key issues that I want us to have a look at. First of all, I want you to highlight your assessment of the changes that have taken place where the bank is concerned, right at the top echelon level of things. What is your assessment of what Ciaran did make reference to?
Yeah, I wouldn't say it's been an easy ride for them. The expectations were quite high in the market. Filling in the shoes of Barclays was not easy. Barclays was one of the top banks in this country, and it being a multinational bank, obviously there were a lot of things that were really expected and that really came out of that bank over its span, over its 50 or so years span in Zimbabwe. But looking at how FCB has evolved and has managed to weather the storm and obviously pushed its operation here, I think they have managed to do better than what people expected. I think looking at the key aspect in my view is to really look at how they have evolved their non-funded business. And that space, they've really done well, putting in a new system, acquiring more customers. And obviously that metrics is quite important because transactional banking is coming to be the dominant factor in driving banking globally. And looking at their funded income space, I would say, yeah, of course, they would say the strategy might not have changed, but the move, looking at their TB ratio as a fraction of the total earning assets, it's really quite high. So I really think that there's no longer that conservative lending approach, but all the same, their NPL ratio is quite conservative, but I think market-wide, I also suspect that there might be a low provision of these bad debts, and therefore there might be a miscalculation of NPLs. But it is what it is. I mean, the broader banking sector is showing low NPL ratios, and likewise FCB is coming in there with those low ratios of NPLs as well. I think it also speaks to the idea that there's been a lot of acquisition of these non-performing loans and efforts by banks to try to write off some of that non-performing loans over the past few years. So they've really lived beyond my expectation as an analyst, looking as well on the managerial side, how they've managed to hold forth despite changes in terms of the chief executive. Two executives actually left over the past 3 years, and now they have an interim CE, a new FD, and a whole lot of other executives who have also moved in one way or the other. So I think they've really done tremendously well. And I also feel that FCB and the parent FMB, they really mean business. I mean, they're trying to grow a Pan-African brand, which has got presence in several African countries. If you look at other banks, for example, Bank ABC, its units in the region was upwards of 5 at some point. And that's exactly what we're seeing right now with FMB, a presence of 5 countries. They really mean business. I mean, we need to give them time. They will stabilize, and I'm very certain that they will weather the storm. You really need, I mean, Pan-African banks of their nature are actually doing good in this market. Look at competitors, EcoBank. They're really doing good. You need to identify your niche. You need to push it. Although the transition is obviously not going to be easy for them, but they've already walked a significant portion of the journey.
Fair enough. And I want you to comment on their funded income and how they are playing in as far as their loan book is concerned, how that there is a 35% orientation towards agriculture. How important is the agricultural sector to the operations of this very bank?
I wouldn't know historically where most of their loans used to go, but I would understand that most of these loans would go to the productive sector. But which particular sector within that, I wouldn't be as familiar. But what I want to chip in there is to obviously point to the fact that agriculture is a big contributor to our GDP. Historically, we have a percentage of about 20% of our GDP is attributed to agriculture, the agricultural sector. Whenever this sector is down, our GDP also falls. So by default, we are actually in that kind of state. So agriculture remains pivotal to this economy. It remains pivotal to even economic growth and even social emancipation, food security, etc. So in as far as that is concerned, it means that funding this sector remains one of the key aims of all the players in the sector who are looking at possibly funding the productive aspect of the economy. So having a book that is largely skewed towards this sector really speaks to that appreciation first, and also that it's really an economic sector that needs to be considered. But then, yes, the climatic aspects have to be factored in. You have to measure risk before you give a loan, and obviously the risk has risen in recent past. Over the past 3 years, 2 of the years over the past 3, we have really faced a severe drought, and we don't even know what the outlook looks like. So I really think that this is a challenge to many banks. I really also feel that it's a challenge to the sector itself. It has to mechanize. We have to move fast to put irrigation within our farms, and we also have to make agriculture bankable. That's one of the key points there. So for FCB to have far much exposure within this sector, I don't really think that it's a big challenge, but really it has to be looked at in the context of all these climatic changes and what they mean in terms of their risk matrices and computation of such. But I think going forward, they really need to pay attention to further details that really speak to the aspect of risk.
And lastly, just before we go, they have foreign currency denominated deposits to the tune of $50 million. That's as at the time that their results were published. And also in the same vein, we're seeing the launch of a market system there by the central bank to try and avail more of foreign currency. Can you just give a comment where the development on that front from the central bank perspective is concerned, and how perhaps it would not only affect First Capital Bank, but how it would affect several banks within that same bracket?
I think the issue of foreign obligations has always been a challenge to this market from the point where we decided to de-dollarize. By virtue of de-dollarizing and having a currency which was weakening against other foreign currencies, it really meant that foreign currency losses or FX losses were actually increasing over the period. So anyone with an exposure in terms of foreign currency obligations, they really felt the pinch. But so as you would know, most banks source foreign currency in terms of loans from outside, and those are measured as deposits as well. And always the issue there from an accounting perspective is to provide or to actually acknowledge these losses in your computation of inflation adjusted earnings. But RBZ has also come on board and said all such obligations which are outstanding, we will be able to settle them. That is those that were accrued before February of last year. The other aspect of having foreign currency denominated deposits may be emanating from the local market. That's a different aspect. This really, if that money is being earned from new money, new forex coming from local depositors, then that's an encouraging development. It really speaks to, their ability to attract such kinds of deposits. But also looking at the new auction system, I think it allows for fair compensation, especially on the exporter side. It restores confidence in the banking sector. It restores confidence in the issuing authority, which is government, and it helps stabilizes the economy, which I think would fare well for FCB and even for all other financial institutions, which are almost facing a huge risk given the volatility in the currency that we're facing right now.
Oh, thank you. Respect for the perspectives. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our informative website, www.equityaccess.net. Remember to catch us every Tuesday, every Thursday, 7 p.m. Central African Time on this very same platform. From the Equity Access team and I, Dunky, and ciao.